Good afternoon, friends, and a very warm welcome to all the participants today. I am Vikas Vasil, the chair and the moderator for this session. We have over 650 plus registrations for this webinar that clearly shows the interest which all of you have in this particular topic. We have an impressive line of speakers today, again from the monsoon hit Delhi as well as monsoon hit Mumbai, where rains continue as per the latest information available. So the format that we have designed for all of you is that first we will have Mr. Brian Burney from USAID to give his welcome remarks. After that, we will have Mr. Puneet Pancholi from Reserve Bank of India. And then we will open up for panel discussion with industry and professional representatives, where we have Mr. Suhas Pendre from HSBC, Mr. Rajesh Kumar Thakur from Commercial Advisors LLP, and Mr. Riaz Thingra from Thornton Bharat LLP. I would request all of you to please feel free to ask any questions that you have. Put your questions in the chat, in the Q&A box, and we will try to address as many questions as we can in our panel discussion. Our endeavor will be to pick up the common themes that you have, because we have received a lot of questions in advance as well. And we will try to address as many questions as we can, which have a common theme. Other questions which we are not able to answer, we will try to reach out to you separately post the webinar. Also, I'm sure there will be certain themes and certain issues which will emerge during the deliberations, as well as based on your questions, which may require further deliberations with the government and the regulators. And I will request IACC Secretariat to make note of those, which we can take as representation to the North Block, Ministry of Finance, CBDT, or RBI, as the case may be. So friends, once again, a very warm welcome to all of you, and thanks for joining in today. Let me first invite my first speaker, Mr. Brian Burney, to give his welcome speech. He is a Supervisory Private Enterprise Officer and Development Partnerships and Innovations Office with USAID. Brian, thank you very much for joining us, and we look forward to your welcome remarks.
Well, thank you, Vikas. Namaskar. Good afternoon, everybody. I am honored to be here on behalf of the American government, and in particular, the U.S. Agency for International Development. Thank you very much to the Indo-American Chamber of Commerce and Grant Thornton for inviting us here today, and to all of the esteemed speakers and guests for sharing your thoughts. I especially wish to thank the leadership of the IACC and its North India Council, especially for your encouragement, assistance, and kindness. As the U.S. government's lead international development, health, and humanitarian assistance agency, USAID seeks to save lives, reduce poverty, strengthen democracy, and improve economic conditions around the world. The IACC and Grant Thornton know that public-private partnerships and continuous dialogue help achieve each of those goals. Today's summit on the global remittances and tax reforms, India's recent developments, will be enlightening. Fortunately, my role here is very simple. I am here to listen and learn. I know that the issues you are addressing are important in India and elsewhere, so I will listen carefully. So thank you for the opportunity to learn about the issues, your views, and your recommendations. Vikas, back to you.
Thank you very much for these opening remarks, and thanks for joining us today, Brian. Before I invite our chief guest, Mr. Puneet Pancholi, Chief General Manager Designate, Reserve Bank of India, I would like to highlight that many of us have seen the journey, how the foreign exchange regulations have evolved over a period of time. In fact, many of us who are the participants today may have heard or read about how things have evolved over the last couple of decades. We had a FEMA regime earlier, Foreign Exchange Regulation Act, which was one of the most stringent regulations which were there in the Indian regulations. And then we evolved about 2 decades back to the FEMA regime, which is Foreign Exchange Management Act, which itself has been transforming year on year basis with a lot of liberalization and ease of doing business conditions being brought in. In fact, if you ask me what's the difference between the FERA regime and FEMA regime, on a lighter note, I can only say that under FERA, which used to be there, broadly nothing can be done except for few things, especially on the current account transactions front. Now, under FEMA, which has also evolved over a period of time, broadly everything can be done except for few things. And let me take you back in the memory lane when FERA regime used to be there and you had to visit any of the foreign countries. That is, if you were required to have any foreign travel, then besides your passport as well as visa on your passport, there was additional thing which was required, which was the stamping on your passport just to get 250 US dollars. So there was a stamp put on the back pages of your passport in order to get any amount of foreign exchange for your foreign travel. And once you have come back, returned to India, there was another stamp put in order to ensure that what is the money that you have returned. So it was that kind of a stringent regulation at that point in time. Businesses, industry, as well as regulations have evolved. Now, if you need foreign exchange to travel overseas, you just need to go online, order it on your Forex card, or just fill in your Forex card in any currency that you desire. Foreign exchange currency can be delivered right at the doorsteps of your office or home. That is the process of evolution that we have seen on the foreign exchange front. We are very lucky today and honored to have Mr. Puneet Pancholi, Chief General Manager Designate from Reserve Bank of India. He brings with him over 2 decades of rich experience of working with the central bank, shaping up, drafting, and regulating various things, including the foreign exchange regulations. Mr. Pancholi, it's our privilege to welcome you, and it will be good to hear your remarks, especially on a couple of topics. First, your broad perspective on foreign exchange regulations as they stand today and what lies in future ahead, whatever portion you want to share with us. Second, in context of liberalized remittance scheme, which is one of the key topics that we are deliberating today, what is the current situation and any changes that you foresee in near future on that? And also in terms of inward and outward investments, especially relating to the foreign investors' investments coming into startups, we would love to hear your perspective. Sir, over to you.
Yeah, hi. I'm sure I'm audible. So good afternoon. Guest of honor, Mr. Brian Byrne, Chairman Grant Thornton, Mr. Vikas Vassal, eminent speakers and friends. Frankly, it's a pleasure to be invited to speak in this webinar, organized under the aegis of IACC. I would have, frankly, I would have preferred an in-person interaction, but I mean, post-COVID, I believe webinars and VCs seem to be the new normal. Maybe later. And thank you, Mr. Vassal, for summing it up so beautifully. I mean, I think you have covered part one, which you mentioned just some time back rather well. I'll just touch upon a few of those points. And I see that the time available is short. And there's some very interesting sessions lined up, so I'll come directly to the point. So as Mr. Vassal, you just said, I'll be covering these 3 points, these 3 areas. I'll just kind of jumble them up so they won't be in the ad seritum. So before delving into the key issues, I would prefer, or rather I feel that it'll be nice if we can have a quick recap of how the Forex regulations are kind of evolved with a focus on, or rather delineating the focus of RBI and the near future changes from a business perspective. I hope this will set the tone or the backdrop for the further discussions during the next 1.5 hours. So, as pointed out at the turnstile of independence, 1947, and going forward, the motivation behind foreign exchange management was primarily to control the demand of foreign exchange, given its limited availability. And what we saw was two versions of FERA in 47 and later in 1973, which imposed various controls on forex transactions. It was in 1990s that a marked shift was observed in the approach to external sector management. The economic reforms undertaken then, they had their underpinnings provided by the High Level Committee on Balance of Payment. It was chaired by Dr. C. Rangarajan, our ex-governor. A plethora of changes they followed. A couple of key ones which I feel are relevant. One is obviously just highlighted by Mr. Vassal, and that is FX is available at your doorstep. So, exchange rate of rupee was made market determined in 1993. And in 1994, India accepted the Article 8 of Articles of Agreement of IMF, making INR fully convertible on current account. However, the key change which I personally feel was the replacement of FERA and the enactment of FEMA, Foreign Exchange Management Act in 1999, where the whole approach shifted from conservation to management of foreign exchange. The enactment of FEMA, it led to relatively free current account transactions, except for a few items, and controlled capital account transactions. Liberalization in this context basically meant gradually freeing up capital account transactions. For the last 2 decades, FDI has become more or less unrestricted, except for some sectoral caps and restrictions in a few socially sensitive, for example, gambling, volatile, for example, real estate, or strategic, for example, atomic energy sectors. Now, policy regime for foreign portfolio investments, I mean, FIIs, as known previously, it commenced in 1992 when foreign institutional investors were allowed to invest in domestic financial instruments, basically equity. Thereafter, FPIs were given access to corporate debt markets in 95, and then later GSEC in 1997. So the FPI regime, if you see, has followed a standard process of liberalizing equity flows first, and then gradually freeing up the debt capital market. So apart from a few sectoral caps, portfolio flows into equities in India are virtually unrestricted. Access to debt market, however, when I say debt markets, both sovereign and corporate, is subject to macro caps and other macroprudential limits, but these are designed to safeguard the domestic economy from excessive speculative hot money. Touching briefly about external commercial borrowing, in July 99, the first comprehensive guidelines on ECB were issued by the government. It has been liberalized over the period of time. Currently, ECB by corporates, while more open than portfolio flows, seeks to enable medium to long-term debt by only healthy corporates, subject to an overall soft limit. A few end uses, for example, real estate, capital equity, are not permitted. Liberalized remittance scheme or LRS facility, which was introduced in 2004, it allowed residents to acquire or hold immovable property or shares and any other assets outside India without prior approval of RBI. And this was in addition to those already available for private travel, business travel, gift remittances, donations, studies, etc. These were described in then Schedule 3 of FEM Current Account Transaction Rules 2000. The remittance for various current accounts under Schedule 3 of FEM CAT rules were available with sub-limits. For example, for overseas travel was USD 5,000, so on and so forth. These limits were subsequently revised upwards for different purposes. More on LRS a few minutes later. Now let me talk a little bit about the overseas direct investment framework, which is contextual. So in keeping with the spirit of liberalization and to promote ease of doing business, the government and the Reserve Bank have been progressively relaxing the rules and regulations on overseas investment and simplifying the procedures. So the erstwhile ODI framework, it was issued almost 2 decades back in 2004. Now, taking cognizance of changes both in domestic as well as overseas financial landscape, the new Foreign Exchange Management OI rules, regulations, and directions, they were brought into play in August 2022. The major hallmark of of amendments of FEMA guidelines with respect to ODI has been ease of entry and exit of Indian entities in foreign financial and non-financial sector, so as to enable them to establish the goodwill of Indian entrepreneurship worldwide. With this motivation, most of the investments have been brought into the automatic route, but for a few sectors that require prior approval. Now, let me list down some major changes vis-a-vis the erstwhile FEMA 19. The quantitative ceiling on total financial commitment in foreign entities by any Indian entity has been replaced with a wide performance-based requirement of total financial commitment enclosed within the 400% net worth of the investing Indian entity. So while FEMA 19 imposed a ceiling of a total commitment at around 50 million USD, FEMA 120 expanded the scope significantly. So effectively, it appears that there is almost no ceiling in most normal cases today. Similarly, the regulation stipulates that while the initial investment into foreign entity should be by the way of subscription to equity, the Indian entity may lend or invest in any debt instrument issued by the foreign entity, or it can also extend non-fund-based commitments to or on behalf of foreign entity, including the overseas step-down subsidiaries within the financial commitment limit. Of course, this is subject to eligibility criteria and other things. Now, another thing is that under FEMA 19, direct investment was required to be made in the same core activity carried on by the Indian party. Now, this requirement has been dispensed with under FEMA 120. Further, Indian entities interested in investing in financial sector abroad can be either operating in financial or non-financial sector in India, subject to some basic conditions in consonance with ensuring financial stability. In the new regulations, if the Indian entity does not meet the net profit criteria due to impact of COVID-19 during that period, then the financial results of such period may be excluded for considering the profitability for the next for the 3 years. That's a criteria which we have. Moreover, as per the new regulations, an Indian entity engaged in non-financial sector interested in investing in a financial services entity situated in IFSC have been granted exemption from the 3 years profitability criteria generally imposed in these cases. Several items which earlier required prior approval have been brought under automatic route. Approvals with respect to invocation of performance guarantee, issue of corporate guarantee for second or subsequent level of SDS have been dispensed with, subject to compliance requirements. Prior approval with respect to investment disinvestment by an investor under investigation by any regulatory or investigative agency or any defaulter has been placed under the auto route, subject to obtaining of NOC. Write-off in cases other than where JV or wholly owned subsidiary is listed overseas, or Indian party is listed with net worth of more than INR 100 crores, or investment less than equal to USD 10 million has been brought under the automatic route, subject to prior price valuations. So the rules have been significantly relaxed for resident individuals. Prior to 2013, RIs were not allowed to invest abroad, but now any resident individual may make OI by way of ODI in an operating foreign entity not engaged in financial service activities and which does not have subsidiary or step-down subsidiary where the resident individual has control in the foreign entity. It is within the overall ceiling under LRs. RA may acquire foreign securities without any limit by way of inheritance from a person resident in India who is holding such securities, or from a person resident outside India, or also from as a gift from a person resident in India who is a relative. RA may also acquire foreign securities by way of gift from person resident outside India in accordance with the provisions of Foreign Contribution Regulation Act 2010 and the rules and regulations thereunder. Further, for ease of business, ratification powers for most of the transactions have progressively been handed over to AD authorizers. RBI's focus has shifted to enhancing the ratification powers of AD banks while streamlining the reporting requirements. At the same time, RBI has also ensured that regularization of delay in reporting requirements becomes smoother. And to this effect, as you all would be aware, the late submission fee or LSF has been introduced in 2022 so as to downsize the time spent in compounding of reporting delays. To further streamline the operational procedure and reduce the turnaround time for processing LSF applications, a new stream late submission fee, as I have already said, has been introduced in OID application. RBI sets aggregate limit for overseas investments by mutual funds, AIFs, and this limit is revised in line with the global and domestic conditions. Currently, the limit for mutual funds is USD 7 billion, and for AIFs is USD 1.5 billion. So the new guidelines have provided better clarity on various important terms, interpretational issues, and introduced a fee of LSF. Again, I'm repeating it because it's something good for the market, for regularization of delayed reporting of overseas investment transactions. So the new framework is intended to largely reduce the compliance burden, turnaround time for processing of transactions and granting of approvals, associated transaction costs, and enhances the ease of doing business. So let me touch upon LRS scheme as Mr. Vassal had asked me to do. So the genesis of LRS, it can be traced to the report of Committee on Capital Account Convertibility or Tarapur Committee. So the report had recommended phased liberalization of controls on capital outflows. One of the recommendations was that the individual residents may be allowed to invest in assets in financial market abroad to the tune of 25K USD in phase 1, with progressive increase up to 50K USD in phase 2 and up to 100K USD in phase 3. So as a step towards further simplification and liberalization of the foreign exchange facilities available to residents, the LRS was introduced in February 2004, which allowed resident individuals to freely remit up to USD 25,000 per calendar year for any current or capital account transactions or a combination of both. The extended scheme is available to resident Indians only. It's not available to corporates, partnership funds, HUF, trusts, etc. For NRIs, PIOs, foreign citizens, the repatriation of their assets in India is under the Remittance of Assets Regulations 2016. So this facility, the LRS facility, which was introduced in 2004, it allowed residents to acquire or hold immovable property or share or any asset outside India without prior approval of the Reserve Bank, and was in addition to those already available for private travel, business travel, gift remittances, donation, study, medical treatment, etc. These things were already described in the Schedule 3 of FEM Current Account Transaction Rules 2000. This facility under Schedule 3 was for various current account transactions mentioned therein, and LRS allowed remittances for current as well as I said, capital account transactions. The remittance for various current account transactions under Schedule 3 of FEMCAT Rules 2000 were available for various sublimits. Initially for overseas travel, the limit was USD 5,000. For study, it was 30K, or estimate from university, so on and so forth. Now, these limits were subsequently raised upwards for different purposes by subsequent amendments to the rules. The latest one being a consolidated limit of 250K. So under the extent scheme, LRS allows remittances for permissible capital and current account transactions. And there's a list of transactions. I don't know, read those out. They are readily available on our website. A little bit more on LRS, if you would be interested. So annual remittances under the LRS, they have witnessed secular growth, except for the year 2021, which had seen some aberrant behavior for obvious reasons. But between 2018 and 18-19 to 22-23, the overall outflows under the scheme have increased by 97%. Capital account transactions from less than 10% of the total outflows under the LRS. This may be possibly because of higher returns on portfolio investments available in Indian markets itself. Empirical evidence has shown that the scheme is utilized mainly for current account transactions, which form more than 90% of the total outflows, and most popular ones being travel and education abroad. It has also been observed that number of individuals who are utilizing the full amount of LRS is minuscule. So what I mean to say is like the total limit, people who are touching the total limit, it's minuscule as compared to the other individuals or other people who are utilizing the scheme for various purposes. So it appears that LRS limit may be sufficient for all practical purposes. Some conditioning motives to review the limit, they may be linked to higher education for youth, requirement for startup, etc. So yeah, that is one point. And second is it's a matter of debate whether the limit should be kept uniform for everyone or otherwise. Let me move to startups. That was another point which was asked by Mr. Vassal. So let me talk about the RBI's framework thereon and delineate RBI's perspective on what industry should bear in mind in respect of foreign investments into startups and to remain compliant with the foreign exchange regulations. So foreign investment in startups in India is governed by the Foreign Exchange Management Non-Debt Instrument Rules of 2019, generally popularly known as NDIR. So these were issued by the Department of Economic Affairs, Ministry of Finance. And the foreign exchange management, mode of payment and reporting of NDIs, regulations were issued by RBI in 2019, also known as FEMA 395. Now, foreign investment in startups must be in compliance with the entry route, sectoral caps, pricing guidelines, and other conditions for foreign investments. Now, entry routes, I am sure people will be aware, there are two routes, namely automatic route and the government route. Investments in majority of sectors in India, they fall under automatic route. Under the automatic route, startups are eligible to receive foreign direct investment without prior approval from the government. Startups can receive FDI up to the specified sectoral caps under the automatic route. Talking about the sectoral caps, there are certain sectors such as pharmaceuticals, brownfield projects, multi-brand retailing, trading, defense, broadcasting, content services, print media, etc. They have specific sectoral caps on foreign investment depending on the sector and nature of business. So startups operating in such sector need to adhere to these caps while receiving foreign investment. Now on pricing guidelines, the basic guiding principle is that a person resident outside India should not have an unfair pricing advantage in a transaction when compared to a similar investment by a person resident in India. So it is provided that acquisition of equity instruments by a person resident outside India shall be at a price not less than fair value, and the transfer of equity instruments from a person resident outside India to a person resident in India shall be at a price not more than the fair value. So that's what we mean, like, there should not be an unfair advantage. The investment needs to be done in accordance with the pricing guidelines. To encourage FDI in certain sectors, a separate class of foreign investors have been recognized under the NDIR with certain exemptions in the capital control measures. Example, foreign venture capital investors, investment in certain sectors are exempt from application of pricing guidelines. Another interesting point here is the issuance of convertible notes. So unlike other companies, startups can receive investments in form of convertible notes. Though initially such investment is in form of debt, the funding received by CNs does not attract general provision of PCB framework. Startups can issue convertible notes to foreign investors for a period of up to 10 years from the date of issue. Startup company engaged in a sector where investment by a person resident outside India requires government approval may issue convertible notes to a person resident outside India only with such approval. Further issue of equity shares against such convertible notes has to be in compliance with the entry route, sectoral caps, pricing guidelines, and other attendant conditions for foreign investment. Other than this, there are prescribed eligibility criteria and reporting requirements that are well laid out on our website. Corresponding measures taken for ease of compliance. These include certain relaxation in forms and reporting. I will not go into the detail of it. Now, as far as overseas direct investment in startups, a constructive difference has been brought about in the FEMA guidelines 2022, and that is with respect to the definition of strategic sector. And this is also where the significance of startups is specifically underlined. The strategic sector is defined as to include energy and natural resource sectors, and startups and any other sector or subsector as deemed fit by the central government. The restriction of limited liability structure of foreign entity shall not be mandatorily for entities with core activity in any strategic sector. Now, further, Regulation 19 of FEMA 2022 prescribes that any ODI in startups shall be made by an Indian entity only from internal accruals, and in case of resident individuals, from own funds or such an accrual. Looking forward, there is something possibly, I'd keep it brief, the looking forward part. So the department's FPD's Foreign Exchange Department strategy for 23-24 is to focus on consolidation and carrying forward all the initiatives. Going forward, the focus will remain on ensuring that the FEMA operating framework is in sync with the needs of evolving macroeconomic environment. In addition, efforts should be made towards role enrichment of APs by way of delegation of powers and rationalization of reporting requirements with the intent of better data management and reduction in the cost of compliance. So there are certain things which have been lined up. They've been part of our annual report also. A few of them include review of compounding proceeding rules under FEMA 99, review of authorization framework of APs under FEMA, rationalization of LRS, rationalization of regulations on foreign exchange management, manner and receipt of payment, regulations 2016, review of guidelines related to rupee account of non-residents, rationalization of guarantee regulations, rationalization, simplification of trade guidelines. So I would end here, and I would again quote what Mr. Brian Bine said, that yes, I am also here to learn and hear from you. So thank you all for your time, and I wish the webinar all the success and my best wishes to all of you. Thank you.
Mr. Pancholi, sir, thank you very much for joining us and giving us an oversight. I think you have laid the complete roadmap in terms of where we stand today, and also given us some hints as to how things are going to evolve in near future. The foreign exchange regulations, which started from control and conservation perspective, have moved to management perspective under FEMA. And I think it may not be an exaggeration if in a decade or so, instead of Foreign Exchange Management Act, we might be talking about Indian Exchange Management Act, where rupee is further opened up on capital account convertibility. And as government and RBI are taking steps in terms of increasing the international trade in rupee itself, probably in a decade or so, we may see some movement on that, or a lot of movement on that. And also as the economy gains strength, so probably FEMA will also need to be replaced in near future with maybe Indian Exchange Management Act. I think we would love to see that change coming in our lifetimes. Thanks for reminding us that FDI is open in most sectors, barring few. And in fact, the government has also gone on record that India is one of the most open FDI destinations in the world. And we have seen FDI inflows into the country increasing year by year. ECB by corporates for medium to long-term debt, again, a popular instrument. I think we would like more liberalization on that front so that more and more corporates can make use of that. Liberalized remittance scheme, which started with $25,000. Sir, in fact, we had forgotten that limit actually. And we were thinking that it has always been $250,000. Thanks for reminding us. Yes, it started with $25,000 and it's 10x increase. I think it's nothing short of saying that it's like a startup valuation going up with $250,000, which a person can spend on current and capital account transactions. And also, it's interesting to note that 90% of that money is spent on current account, basically on travel and education. I think that's one area which the government is also looking into as to how to conserve foreign exchange on that account as well. IFSC is a new buzzword, again, a good opportunity both for inbound and outbound investments. RBI is moving more towards an oversight and regularization mode rather than controlling mode. In fact, recently we read that in context of the mutual fund investments overseas, there is so much of investment going abroad that we have already crossed the mutual fund limits, and I think everybody was requesting RBI to reconsider and increase the limits as well. So that's the kind of investments flowing out of India today, and that also shows the income levels which have gone up thanks to the further liberalization which is happening in the economy. On the startups front, again, basically the FDI sectoral caps apply, and pricing guidelines provide us a good guidance. And again, it was a good reminder that the underlying theme of the pricing guidelines is that there should be no unfair advantage to a non-resident or to a foreign investor vis-a-vis a resident in India. I think we should keep this point in mind. And in terms of the future agenda, consolidation and carry forward of the reforms, FEMA in line with the business requirements, that's where the chambers like IACC play an important role in terms of making representations and highlighting the issues which businesses are facing. Data analytics, data sharing, compounding rules. And I think one thing, sir, which caught our attention was further liberalization of LRS, and some points we are going to deliberate and discuss in our panel in terms of what could be the possible rationalization or liberalization or control which could come in, keeping in view what we are hearing based on our discussions with you and the other regulators and the government as well. Once again, Mr. Pancholi, sir, thank you very much for joining us and providing us this oversight. Thank you very much. Friends, let's start with a panel discussion now. We heard from Mr. Pancholi as to where we stand today on the liberalized remittance scheme, inbound and outbound investments in startups. Let me invite my panel members, Mr. Suhas Bendre, Senior Vice President, Regulatory Reporting Services with HSBC. He brings with him over 3 decades of rich experience in various functions in the banking sector. Suhas, a very warm welcome to you. I have with me Rajesh Kumar Thakur as well, who is a chartered accountant. Again, he brings with him a rich experience of 20 years as a finance controller and CFO, working with some of the largest organizations, working on projects involving multiple crores of investments and management. Welcome once again, Rajesh.
Thank you.
And I also have with me Riyaz Tingna, whose focus has primarily been on foreign exchange and tax matters and emerging policy issues on tax and policy front with Thornton Bharat. Riyaz, once again, a very warm welcome. I think, Suhas, let me start with you. And you have seen it day in and day out in terms of the liberalized remittance scheme, where we started with about $25,000 to now $250,000. What's your perspective in terms of how things have evolved and what exactly, and where do you see the things evolving further in terms of the requirements which people have? We all know that the amount being spent by individuals is going up thanks to the rise in the income levels. Travel has increased. We are not able to get visas that easily. There's a lot of waiting time because a lot of Indians plan to travel both for business as well as personal purposes. In fact, it was not long back, and I know Brian is on the call, it was taking more than 365 days in certain jurisdictions to get a visa as well. So there is increase in travel. Similarly, on education also, the spend has increased multifold. In fact, few $1 billion are spent by resident Indians on education of their kids overseas every year. So it will be good to get your perspective from the banking industry perspective. Where does the LRS stand today, and what are the key issues which we are facing in respect of the LRS scheme today?
Yeah, thanks, Vikas. I'd like to put some facts on the table. First of all, when LRS was introduced in February 2004, it was introduced as in addition to existing current account limits. Yes. If you look at then prevailing current account limits, if you look at, especially the key one, if you look at medical treatment, not everybody requires medical treatment abroad. Very few may be doing that. If you look at immigration, Not everybody migrates overseas. Very few of them go away. Major requirement was family maintenance. Rich people, upper class people whose kids have settled abroad need to support them in their need of our education and travel. These were the three requirements in terms of the current account transaction. If you look at FEMA current account rules, 3rd May 2000, if you look at, it had a limit of $1 lakh for family maintenance per relative, not as an annual, but per relative. So if a family has 2 kids staying abroad, technically they could have remitted $2 lakh in 2004 for their maintenance of the kids, plus travel and plus education plus. So really speaking, in February 2004, it may be inappropriate to say the limit was $25,000 per individual. It was actually $225,000. If I split the period over last two decades, 2004 to 2014 and 2015 to 2023, then the limit increased from $25,000 to $2 lakh by 14. Now $2 lakh in 14 plus $1 lakh per family member as a maintenance. Technically in 14, an individual had an ability to emit $4 to $5 lakh as a family maintenance plus LRS family maintenance. Secondly, if you look at why capital transactions are on the lower side, if you look at in 2014, Nasdaq index on an average was 4,900 Nasdaq index. In 2023, it is roughly around 10,000 to 12,000. If you look at average property price in UK, in 2014, it was around 2 lakh pound, 2014. Average price has become 3 lakh pound, over 3 lakh pound for UK property. So an individual, typically a buyer, resident buyer, wants to buy property abroad. The seller may not like to get installment. He will like to have deal at one go. Secondly, a resident individual is not allowed to borrow overseas. That means he can't have a liability created on overseas. So therefore, property transactions, either people are adopting ODI route or some other not permitted or some kind of a shamming in terms of trying to acquire the property, because property prices have gone up, whereas LRS limit is $2.5 lakh. In 2015, LRS limit got subsumed with all other earlier limits. So now practically $2.5 lakh is for current plus capital both, current plus. And major kind of a requirement of the people is family maintenance, then education or travel. So therefore, people are using travel as a mode to payment. If you look at a family of 4 doing a vacation abroad with SOTC or Thomas Cook for a 1 month or 2 month vacation abroad, it may not cost 50 lakh to 80 lakh, not more than that. Family of 4. So if you convert that into a dollar terms, it may be less than $1 lakh actually in a year as a travel. Despite that, we see a spur in number of travel remittances because people are not able to buy property. They are using some other means. It's a declaration-based remittance, LRS. So people are using travel to remit the money here. So I would urge RBI to look into the indexes in terms of the property prices going up, the share index going up, and look at it in terms of how can people create assets abroad rather than spending abroad. That's what my thought was.
Thanks, Suhas. So what you are saying is that there is a need to increase the limits, keeping in view the various inflationary factors and also the aspirations of the individuals. Now, let me put 2 perspectives. One, yes, as a nation, we have roughly about $500 to $600 billion of reserves in foreign exchange, which puts us in a very comfortable position. At the same time, there are a lot of demands from the industry as well in terms of businesses for foreign exchange, for import of various technologies, machinery, etc. I think these are 2 divergent perspectives. And if we look at our neighbors, maybe China or other countries where capital account restrictions are there, I think if we compare ourselves over there, then the limits that we have in India look very reasonable. So what's your perspective in terms of, on one side, we have good amount of foreign exchange reserves. On the other hand, there is increased demand both from industry as well as individuals and the government as well in terms of the capital imports, in terms of technology, etc. How do you think a balance could be maintained between 2? And I think one point which we would like to invite your users is single limit for everybody a nice recipe, or there could be some tweaking which should be done now?
Yeah, so I'll answer in 2 parts here. First, with respect to how it stacks up in terms of our import requirement and balance reserve or whatever here. So I will digress a little bit here. If you look at the ECB policy of the government and RBI, if you look at it, when it was introduced in 1999-2000, the limit was $50 million, and practically every sector, every end use was permitted with the prior approval of RBI. In January 04, the policy was changed and made it to the real sector, that is manufacturing, infrastructure sector, and some select service sectors, software, hospital, and hotel here. And the thrust of the policy in January 04, that if your country is borrowing, if the debt of the country is going up, it need to be for productive asset. It need to be for an increase in capacity. It need to be. So taking a cue from that, right now, if you look at the LRS, majority chunk goes for spending, not for asset creation. So if a separate limit can be set up where assets are created, because ultimately assets will be owned by Indians. So if for a separate limit is created for asset purpose only, right now it is combined with current account transaction right now. So if a separate limit for asset is carved out, a country will own the asset. If you own the property overseas, Indian cities are going to own the property, own the asset over here. So therefore, that kind of approach can be taken. So if money is going out of the country, it is going out for creating asset for the country. It is rather than spending on LRS travel or something. Rather than that can be, there can be dual category of limit. One for current account spending, and second for asset creation. Secondly, with respect to differential limit for people, yes, there are, to my knowledge and my interaction with RBI, last 20 years I've been interacting with RBI. There are people who have paid 5% TCS erstwhile and not bothered to claim refund because they don't want to disclose their income to the income tax authorities. And probably that is why one of the reasons TCS proposed to be increased from 5 to 20%. That is why. Now here, there are people who travel abroad without disclosing income, without filing return. So therefore, it's a good case. The differential limit should be there with the upper cap. It's not that the ultra HNI can remit whatever amount they want. It's not that way. So upper cap should be there, but there can be a differential limit for respective individuals.
So let me bring in another perspective. 5% TCS going to 20%. I think the tax professionals are not very happy with that. So Riaz, what's your take? What you're hearing from the business and the industry in terms of 20% TCS? Because it definitely increases the cost, even though it's more of a cash flow issue, but it is an issue. So what's your perspective on that?
No, thanks, because that's a very valid issue that, while we keep saying that 20% is not a big thing for a ultra high net worth individual, we have to understand that as far as monitoring these transactions are concerned and finding out how, whether LRS spends are commensurate with the level of income, that I think there is enough data available with the government to be able to do that. So just to find that data, this increase may not be justified. Secondly, very rightly put, the cash flow issue can be more severe for some people and less for others, because it's not only on the level of income. A salaried person may have very little advance tax payable, large amount of TDS, even the very high levels of salary. But for business, there would be more advance tax, so maybe the time for which the amount is held back may be relatively smaller. So therefore, for a salaried individual, it could be more than a year that the amount is actually staying behind. So the cash flow issue is also a serious issue that one should look at, and one size does not fit all. So if we have to, we need to know why we are doing this. If there are people who are filing their tax returns, they should be paying maybe a lower rate as compared to others who are not. I think that would be a more pragmatic approach.
Yeah, practical challenges also, because many a times, even for business travels, individuals use their own forex travel expense first and then claim it as a reimbursement. So 20% of their cash flow will get blocked over there. And especially if you're traveling towards the end of the year, then again, maybe you have already paid your taxes for the year. You may not be eligible to claim credit, and you have to claim it through a refund process for filing your tax return. Now, the moment 20% TCS got introduced, there was a lot of hue and cry. and there was a lot of representation made. And I think there have been 2 or 3 series of developments post that. What was the reason for government to, of course, it's great that the government listened to the various issues which the industry was raising, including the banking industry, where they said that our systems and processes need to be tweaked and we require time. So highlight some of the practical issues which people face and the government listened, and still there are certain gray areas which remain.
Sure, absolutely. There have been a lot of changes which have come in over a relatively short period of time. And at least now some of the new TCS rates will only be applicable from 1st October, mainly to make sure that the banks also have enough time. But clearly, when these provisions were introduced, a lot of things were not considered. And even today, some issues and gray areas remain. For example, you rightly pointed out about, business spends sometimes when employees are going abroad, business spends versus personal spends. Now, when an individual is going to claim his expense, he is actually out of pocket for 20% at the first level. Even if he uses a corporate card which is in his own name, typically, as per the regulations, this would be under current account transactions, not to be covered by LRS limits, but it's impossible for the bank to identify what portion of that expenditure incurred on the same card is on personal account and what is on business account. So that may create a problem. So maybe if a corporate credit card is issued, which is directly paid by the company itself, that could be an answer. There are various other issues which come in for use of credit cards. Add-on cards. While the invoice comes in the name of the primary holder, whether the add-on card expenditure will be considered as a utilization of the LRS limit of the add-on card holder or of the primary holder, that would be another issue. And I think even for overseas packages, now there are some clarifications. We are saying that at least 2 of the 3 possible expenditure covered under an overseas travel, like air ticket, hotel, credit, boarding, and other similar expenditure, at least 2 of those expenses should come in. Now, that may not solve the purpose, because what happens if the same vendor is being paid in 2 separate invoices? There would be a lot of, misuse of those kind of gray areas. So I think there are clearly areas on LRS and TCS which need to be looked into more from the practical day-to-day application of all of us.
So you mentioned that if it's a corporate expenditure, corporate travel, it's covered under current account transactions. However, the way practically the expenditure is incurred could pose a challenge. If it's a corporate credit card paid directly by the company to the issuer, say a bank, then there is no issue. However, if it is the individual's name who incurs expenditure first and then claims a reimbursement from the company, there could still be an issue vis-a-vis levy of 20% TCS.
Absolutely.
So
sorry.
ahead,
So maybe practically, I'm sorry, but practically maybe, one will have to see whether it's best for foreign exchange to be purchased and for business expenditure. We will have to look at our special products where the corporate cards are clearly only for corporate expenses to be paid by the company. Maybe Suhas will have a lot of work to do on that banking side.
Sure. So Suhas, for the time being, the government has put on hold on in context of some of the credit cards, and they said we will come out with the revised timelines once the industry is ready. So what are the key issues which you think that the industry was facing on this aspect? And I know many representations were made to the government.
Yeah, so I am privy to the meeting which RBI called for discussing on the TCS. Okay. I was part of the meeting along with 5 fellow bankers and 4 card companies actually. So we have jointly made a presentation to RBI what all the problems can be expected. So let me put a credit card I spent overseas vis-a-vis FEMA. So if you look at FEMA current account transaction, FEMA, import of goods is outside LRS. So if I go abroad, if I go to Singapore and purchase a laptop using credit card, and I bring laptop under green channel within my limit, whatever, or pay custom duty within the DGFT guideline, then import of laptop is not LRS. If somebody goes to internet and purchase cosmetic using a credit card, then import of cosmetic is outside LRS. Even I go to Dubai and purchase some gold chain as a jewelry, import of gold to some extent is allowed by the DGFT, so that is outside LRS. So import is outside LRS, import of goods services outside LRS, import of your Schedule 3 transaction, that is travel, gift, donation, family maintenance, education, that is LRS, that is. So how does AD Bank verify that what is LRS and what is not LRS when card is swiped overseas? There is one method to do that. That is, every vendor, merchant has something called as a MCC, that is merchant category code. So based on the merchant category code, you can classify a merchant as a jeweler, or a merchant as an electronic goods supplier, or a merchant as a hoteler or a restaurant, whatever. So that was the one way to do it. Secondly, foreign nationals working in India, they are treated as a resident in India. They are allowed to remit net of tax salary without any limit. So if a foreign national is working in India, goes to home country on a vacation and uses his or her credit card issued by bank in India, whether TCS will apply or not apply. Because foreign national is allowed to remit outside LRS. His salary income is freely remittable and net of tax salary. So that is another angle. What should we do about such credit card? Thirdly, around 30 to 40% credit card in the market. People own credit card of a bank but don't maintain bank account. So how does bank will levy charge? Whether that charge need to be added to the credit card bill? That means somebody swiped 10,000 rupees worth goods overseas, and 20% is the charge. So bank should charge 12,000 rupees to his card, or bank should charge 10,000. That's a question mark. So operational aspect in terms of how the recovery to be done, that is the key challenge. That is the. Lastly, credit card input received by the bank from Visa or Master or Amex or whatever, it is in a different format. Bank need to decipher that and bring it to the purpose code of LRS for reporting purposes also. So these all challenges were there. And earlier there was a prescribed limit of 7 lakh only for education and medical. Now government has changed that and made it for every category of remittance. Otherwise it would have been another angle for bankers to verify कि 7 lakh apply hota hai ya nahi apply hota hai. So these are all challenges of bank how to implement, and that's why probably government has taken a 3 months time to think over and come out with a further revised version probably.
Excellent point, Suhas. Rajesh, before I come to you for some of the compliance side of the issues, Suhas, I think there will be another issue which banks will have to grapple with, which is that generally banks offer, or the credit card issuing companies offer, about 45 to 60 days of credit. Now this 20% additional burden, it means they will have to pay first or collect, but you can only collect after the credit cycle is over, or you change your billing cycles then.
Very, very true. So unlikely billing cycle will change, because that will be massive change actually. In billing, so I don't think billing cycle will change, but some guidelines with respect to TCS deposit by the collector to be done in the T+1 basis or T+1 month basis, or next one by 7th of the month. So that need to be prescribed with respect to card users. Cycle unlikely to change. I don't think so, because it will be massive change for banking industry if the cycle changes.
So I think a couple of issues with the banking industry is grappling with. One is how to distinguish between different kinds of expenditures, because not every expenditure will get covered. It's very difficult for a banker to identify based on the credit card statement which expenditure will get covered for TCS and which will be outside of that. That is one. Second, in terms of the additional credit flow which they will have to offer up to 20%, because the billing cycles are not going to change. So I think some very pertinent issues. I'm sure government will look into it. And I think building upon what Riaz mentioned, that whether 20% TCS is only a tax collection or information gathering mechanism as well. If it is information gathering mechanism as well, why don't we consider a 1% or 5% straight TCS on entire amount? And then we have the information, we have the tax returns which are already linked, where the PAN and Aadhaar have already been linked. All the information is available. And I think data analytics could be used in order to collect revenue, but putting the government's perspective as well, because we had occasion to interact with many of the senior government functionaries on this. Their point is there is active misuse of this channel right now, where people are traveling and they are not either filing the returns or not paying the adequate amount of tax vis-a-vis the expenditure. That's the reason this kind of a step has been taken. I think some pragmatic measures or approach needs to be adopted on that, but more on that bit later. So, Rajesh, let me come to you in terms of the compliances which are required, both under the LRS as well as because the TCS. Just highlight some of the issues which people face on this aspect. You are on mute, Rajesh.
Yeah. So in case of the like a TCS, so people has like a of the all other kind of taxes. So collector has to deposit the quarterly return of the same, and it will reflect like a in 26 AS of the buyer as a credit amount. So they can get the credit amounts. And as I rightly said, let's say 20% cash outflow, government has intention to like a use the expenditure for the travel and for the like education purpose in the domestic market. So they want to boost the domestic market here. So that is the basic reason what I understand, I think, to increase the TCS rate here. In case of the like LRS at the time of the remitter, so currently bank don't have the real time like a system to know what buyer has to already incur the expenditure. So I think they have totally depend on the like their undertaking form. So whatever they are putting the form, so that will be considered to deduct the TCS. And currently, it is now put on the like a buyer side liability to declare correct things in their taking form, and on that basis, bank has to declare. So, in case of there is any like a misguided information or inappropriate information that is not is correct, so buyer will be deemed as a associate default. Bank don't have the any liability on that side. So these two things are important side, and other point like a in case of the remittance, like a buyer has to, another person has to already collect the, like in all other cases, 15 C and CV. So they has to provide in case of the like expenditure is more than 5 lakh and 15 CV is also required. And in case of the less than 5 lakh, then 15 C is only sufficient document to transfer the fund.
And Rajesh, keeping in view the liberalization, it's so easy to collect foreign exchange, either in the forex card or currency from different authorized dealers, right? Different
Right.
banks, different ADs. How do you think the scheme will function vis-a-vis each of the ADs? Say if for one travel you have taken the forex from X bank, and for another travel or for funding the education or medical expenses, you have taken the forex from another person or another AD.
So it's totally now it depends on the buyer. They have to give the current details in their undertaking at the time of purchase of the forex element.
I'll chip in here. I will. There is a system. There is a system of RBI available to all AD banks, where irrespective of customer whether banks with the bank or not, this is PAN number. Before executing the transaction, we can verify his available limit.
Okay.
What is utilized? That's across banking industry, all banks. That is.
Okay, so it may be updated now.
So,
Yeah.
Suhas, practically, you are saying that the banking system has the availability, which includes all the authorized dealers as well, which are not the banks per se, wherein
Yeah.
you can check by inserting the PAN number of an individual, how much forex an individual has obtained in a financial year.
Under LRS, yeah.
Okay, okay.
Yeah.
Because generally we have seen banks insist that if you have availed any foreign exchange from that particular bank itself, and then they will apply those limits or accordingly the TCS limits which were earlier get triggered after a certain threshold.
The circular says that the individual need to designate AD bank for routing LRS remittances. The circular uses that language. Now it is not followed to the T by many individuals. It is not, but especially for capital account transaction, it is followed especially. But the LRS circular does mention about individual designating a AD bank. So that's why probably bank insists that you need to do transaction through us only.
So yes, after all the representations are made, certain limits were again reintroduced. What's your take on these limits? Are they sufficient to meet the requirements of the individual travelers and various expenses being incurred? And whether it is in respect of overall limit or per expense to be incurred?
I think overall, if it is current account, and as Suhas rightly pointed out, it's basically to take care of travel and hospitality, etc., those kind of expenses, then I think the limit by and large is sufficient. But it is interesting that, Mr. Pancholi also referred that if we are going to talk about dynamic limits, then yes, because individual cases, depending on the profile of people and their travel, there may be a higher amount needed, but by and large, 250,000, as long as it is restricted for the purposes that you are mentioning, that is hospitality and travel, it's enough. The challenge arises that originally when LRS was introduced, we spoke about, acquiring immovable property, acquiring other assets. Now there are limits. And if one really needs to apply to purchase immovable property, etc., then even if limits are not introduced, maybe some sort of a leverage should be permitted to be taken for people to be able to make those commitments to buy the property that they desire.
Okay, thanks, Riaz. Rajesh, what's your view in context of the non-resident Indians, NRIs, because they constitute a significant portion? If they are working overseas, how can they avail, or how does the LRS scheme apply to them?
So this scheme is apply on the resident individuals. So as a person who fulfill the condition of the under section 6 of the income tax act, they are eligible to take the LRS scheme. So if a person go on for employment for the long term and doesn't fulfill the condition of section 6, so they are not eligible to get the LRS scheme.
Okay, thanks for the clarification. Let's change tracks now and move to another interesting topic that we wanted to cover, which is in context of the startups. Suhas, let me start with you. In terms of the inbound and outbound investments, especially linked to the startups, are you seeing any visible change in terms of the structures or the remittance flow?
Not much statistics available with me, but I can say something here is that last 1 and 2 years, rather 1 to 2 years, the ticket size of investment in startup has gone down. Maybe because of valuation or whatever. But if it used to be X earlier, it is almost X by 2 now. So the size of investment coming in the startup by venture capital fund or private funds or whatever, that is come down to 50 to 60% ticket size than what it used to be earlier. I don't have much statistics with respect to in terms of how as a country startups investment is happening, because I don't have that line of sight. So I'm not able to answer that question. Probably.
Sure. Thanks for your inputs.
So could I add something there, with relevant point that Suhas made on the values coming down. So basically, I think when the recent changes that came in, where we have now included from the tax position, the section 56(2)(7)(b), income tax includes transactions of non-residents which are not included earlier. What it has done is that the total valuations have been severely affected. And therefore, while it was an anti-abuse position, startups are really affected a lot, because startups are generally valued on the perceived potential rather than the fundamentals of past performance. And because of this restriction, whereby any amount paid above the fair market value would be subject to tax, the total values have come down. And in fact, I've got some statistics that foreign investment over this current year has gone down in startups, has gone down by more than 72%. So the same period last year there was an investment of about $16 billion. This year it is around $4.5 billion. So there has been a significant impact on the valuations of startup, arising more out of the income tax provision, section 56(2)(7)(b) being extended to non-residents also.
But I think, yes, that will also be keeping in view the general economic conditions as well, because there is a funding winter which is going on, and in general, the investments have dried up. And even in respect of, we have seen some of the committed investments also in the startup, they are taking more time. So I think it's also to do more, it's also to do more with the general economic conditions and the money drying up for the startup, and maybe partially because of regulations as well, which I'm sure our regulators will consider. Now,
So it would be a combination of both. Sorry to interrupt, Vikas, but it could be a combination of both because we are seeing some large ticket items in the last few months. Swiggy's valuation was cut down by Invesco. Baiju's valuation was slashed by BlackRock. So I think Nisho's investment was brought down by Fidelity. So there has been a significant reduction in values also, but it's a combination of both. You're right. Absolutely.
So yes, you touched on a very important point in terms of the recent changes which have been brought in vis-a-vis startups. And I think angel tax is what you touched upon. Just give us a little oversight what the issue is. And earlier it was primarily for domestic investors, but now I think the foreign investors are also getting impacted.
Yeah, so angel tax, as we call it, is this section 56(2)(7)(b) of the Income Taxes Act was originally introduced in 2012. The stated purpose at that time was to deter the generation and use of unaccounted money. So basically, by issuing of shares at very high premium, you could be misusing or abusing the provisions to create for unaccounted money. So that was the purpose it was introduced. Thereafter, startups got affected the maximum out of this. So then various provisions were brought in, trying to provide relief to startups. And they have their own set of issues, some of them which have not been resolved yet. You need to be registered with the certifying authority, etc. And there are some problems which are operational problems which are being faced. But recently, there have been some changes. And one of them, as we just referred to briefly, was that these provisions were extended to investments by non-residents or foreign investment, which was not the case earlier. Now, clearly, this must have been triggered because of some information that the government would have had for foreign investment also being used as a tool to create that unaccounted money. But there is an impact, and it has definitely impacted the flow of funds into the country. Some reliefs have been granted. So you've got safe harbor rules which have been brought in for giving a 10% tolerance limit. Some classes of non-resident investors have been exempted from the application of this angel tax. But there actually it's interesting that while a lot of startups, some entities have been exempted, these jurisdictions do not include some of the major jurisdictions to which investment comes. For example, it doesn't include Mauritius, it doesn't include Singapore, it doesn't include UAE. So there, from where some of these investments are flowing in, those have not got exemptions. So, well, it is evolving. A lot of changes are coming in, and we hope that some of those concerns are actually taken care of to ensure the startup culture being encouraged in India.
Very pertinent points you raised, Riaz. I think one of the basic questions that we always encounter is in terms of the valuation of a startup. And as the old saying goes, that beauty lies in the eyes of the beholder. I think valuation is based on multiple presumptions. Would it not be fair to say that if an independent party is investing into another independent party, which is the startup, whatever valuation they agree to, subject to certain broad norms, should be accepted, whether it is for domestic investors or foreign investors? Any kind of methodology or the formulas that we use are merely based on multiple presumptions, which in most cases do not hold true as we go along. Your perspective on that?
So two paths have been taken care of in this respect. While in all genuine transactions, you are absolutely right in stating that valuation finally depends on the needs of the buyer and the seller. And therefore, that by itself determines a fair market value. But clearly, these provisions have brought in to prevent abuse, where this route was being chosen by individuals to root in certain unaccounted money. So there are two initiatives that the government has taken. The first one is that they have specified some investors. So if there any consideration is received by a company from the issue of shares from a non-resident entity which is notified by the central government. So some entities have been notified. If they have bought the shares at a particular price, then that becomes the fair market value for subsequent transactions. So somewhere trying to look at the market conditions, it has been done, but cannot be clearly opened up. Otherwise, abuse will happen. Unfortunately, I think this price matching has not been extended to residents. So I think it should also be included for some resident transactions. The second thing that has been done is valuation norms. So there is a press notification that has been sent out for public comments for different valuation methodologies to be included as acceptable for determining the fair market value. Now, of course, let's see how it actually evolves, but there may be some challenges because when it comes to determining the valuation, then you need a merchant banker's certificate to determine the fair market value. So these methods, whatever it is, will still need to be ratified by the merchant banking community. But at least it will bring on par to some extent the provisions under the FEMA and under Income Tax Act, because FEMA says any internationally accepted method of valuation should be determined as a fair market value. So I think increasing these methods will be a step in the right direction. May not be completely resolving issues, but it will make a difference.
Thanks, Riaz. I'll come back to you and Suhas on the structures and the flipping of the structures. Before that, let me ask one question to Rajesh, because this is coming up from various participants as well. In terms of the outward remittances that we make, is certification required for each and every remittance, or how is it to be done practically?
So practically, as per like we require a section 195. So for any remittance, we require to get the certificate. So in case of there is some condition had let down, if payment total expenditure is less than 5 lakh, in that case 15 CA is sufficient. But in case of the total expenditure more than 5 lakh, then we have to take the 15 CV from the chartered accountant, and they have disclosed all the facts and applicable tax on that amount, if anything, as per DTA and the local. So that has to be taken.
I think this is an important point which participants should take note of, that above certain thresholds, these certification will be required. And please,
I'll also add here, there are 33 types of remittances, the items which CBDT has declared, given a circular, where 15 CB is not required. They are given an exemption for a list of 33 items. So if your remittance happen to fall in those categories, then 15 CB is not required. It should be available on the CBDT site. If they don't fall in 33, then banker will insist for 15 CB.
perfect. Thanks. Very valuable inputs, Rajesh and Suhas. Now, Riaz, coming back to you, in terms of the structuring, there's always been a debate between India structure, overseas structure, flipping of structure. What are you observing currently on this particular issue? And then we'll move to the next topic in terms of ODI regime as well.
So just, honestly, as far as this flipping of structures is concerned, I'm not seeing a significant movement on more transactions. We did see a lot of movement on flipping structures some time ago when we spoke about Hong Kong becoming not such a favorable place. Earlier, before that, with Mauritius also there was certain concerns. But at present, we are not seeing much of a movement on that. But when we come to the ODI part, I think there this will be relevant because of the round tripping issue. So I think, I don't know if Suhas has a different view on the number of transactions for flipping happening.
Yes, on the flipping on the ODI, Riaz, the reversal is happening now. Promoters who had done a flipped earlier are approaching through AD Bank to Reserve Bank of India to get a post facto approval and compounding. I'll share one case study with you. A promoter formed company in 15 and 17, they got investor interest. They flipped typically using gift structure, where a friend gifted a company formed in Singapore, 100% shares were gifted. We had arranged a promoters meeting with RBI official, and our RBI official asked a pertinent question to me as a banker, saying that one fine morning, blue morning, would you like to gift 5 or 10 lakh rupees to your brother? So I said, it depends on my ability. And secondly, normally it depends on occasion. So if it's a housewarming or it's wedding anniversary or birthday, whatever, some occasion, I may attempt to give him some gift. So that was the answer expected by the RBI official, because he picked up that point, saying that even in the blood relation, we just don't gift just something like that. In blood relation also, we gift normally on the occasion, rarely on the fine blue morning. And whereas the gentleman, look at it, his friend formed a company in March 17, and 100% company out of national level affection, he gifted in May 17. So the point RBI officer was making is that FEMA allows gift as a mode for a single individual acquiring shares of foreign security. There are two golden words in FEMA. They are bona fide. It can't be modified. Intention can't be malicious. So they are clearly, unless proven otherwise, there's a case that a friend gifting a company to a promoter, and then immediately he's flipping the structure where he transfers shares to that company, Indian company. A clear case of you can't do ODI where there is a step down subsidiary. To violate that or to bypass that, you have adopted a gift structure. So I had seen a spurt in number of promoters approaching bankers now. We at HSBC have handled at least half a dozen cases in last 1 year, where we have represented various promoters to regularize their structure. The way to regularize is to corporatize it now, transfer the stake to form a LLP or a company, and get a UIN and transfer the stake to the LLP or company, because now the round trip with 2 layers is allowed as of today. So once you transfer it to corporate, LLP or corporate, it becomes a regular structure. There will be some tax angle, because when you transfer your own stake to own company, definitely at fair value, some taxation angle will be there. But that's the cost you may have to bear probably for a flipping structure already. But now
We can comment at that time.
Yeah.
Is it?
The reversal trend is happening.
No, so it is important, but Suhas, at the same time, there was a genuine requirement to do this for 2 reasons. That the flip structures were being done, because you got higher valuations abroad when you wanted to get funding, and more available funds were possible. So what used to happen is that for every $100 invested by the promoters, they also leveraged another $300, and finally that was invested into the Indian operation. So it was not necessarily bad for the economy of the country, but there were different purposes for different structures, but some of them are very genuine and bona fide.
Sure. So I think a word of caution coming from the panel on the structures right now, and we are seeing some reversal in the thought process, as well as people actually looking at flipping the reverse structures down. So I think a point of caution over here. Of course, the regulations have evolved. There have been further liberalization and encouragement from the government to have structures based in India as well. But again, certain caution points remain over there, both from tax angle as well as the FEMA angle. Riaz, we are moving towards the end of the call. Just give us a flavor on the ODI regime, especially the few layer structures that we have, and what are the key challenges which investors are facing today?
So the new OI rules, the overseas investment rules, which replaced the ODI rules, now permit round tripping up to a 2-layer structure. when we said a two-layer structure, it became, it created a lot of confusion. And then finally, the RBI has clarified in its meeting with the 80 banks, which Suhas may be able to confirm, that the two-layer structures, when you have to compute, you do not count the Indian layers. And if you are not counting the Indian layers, therefore you could have in India invested into Mauritius, which invests into India, or India investing into Mauritius, which is investing into Singapore, and then investing back into India, that would also be permitted. And even if one India is that structure of India, Mauritius, Singapore invests in multiple Indian entities, it will still be permitted. So this, I think, clarifies the position significantly. And what I was talking about earlier of, bona fide transactions also can actually utilize it for leveraging and getting higher investments outside India. That can be taken care of here. But having said that, I think each transaction, each structure will need to be looked at not only from the FEMA perspective, but the general avoidance provisions under the Tax Act to see that there is a bona fide business reason to do that. There are some other issues of gifts and all that Mr. Panchali also referred to, which I'm not getting into, but I'm just talking about stopping at round tripping here in the interest of time.
I think
Suhas,
Suhas, any quick comments on that?
Yeah, absolutely right. RBI had clarified to 80 bank in the webinar that two layers are overseas layers, Indian layers not to be counted. Absolutely right.
Okay, great.
Okay, great. Thanks. I think a couple of points on this. One, commercial substance has to be looked into. Genuine business transactions should be there to justify these kind of structures. And obviously, whatever regulations permit, you have to be bound by that. I think some very interesting discussions today. We still have a lot of unanswered questions, which we will cover post the webinar, and we'll try to reach out to the participants in terms of some of the specific questions they have asked. I think a couple of key takeaways from what we heard from different speakers is A, there has been significant liberalization which has been done on the foreign exchange front, right from the FERA to FEMA and to where we stand today. Again, further liberalization is likely to take place in this year as well as next year. That's on the card, that's on the agenda and on the cards of RBI as well. If there's anything specific that needs to be done, we should approach through IACC and make our representation. I think on the liberalized remittance scheme, we should be a little cautious and careful, because what looks like is there is a thought process in terms of conserving the foreign exchange and making it more linked to the specific requirements or needs. Now, we do not know whether the limits will get tempered, whether they will be brought down or they will go up. Number one. Number two, whether they will be made specific expense based, for example, separate limit for education, separate limit for medical, separate limits for travel, etc. And whether they could get linked, as is the popular thought process going on in terms of the income levels filing linked to the income tax returns as well, because that's another thought which is coming up. And we heard that some rationalization, liberalization is likely to be on the cards. But I think at present, it could be only wishful thinking and what we want. But definitely, there is a demand from the investors to further liberalize on the LRS limits, number one. Number two, TCS in the present form should be looked into. Government has done a lot. We really appreciate that and applaud that in terms of listening to the stakeholders and bringing in changes. Thank you very much to all the participants for joining in. And thanks very much to my fellow panelists for sharing their views. And with this, we close the session. Thanks very much.
Thank you.
Thank you.